Just before turning 28, Bill Ackman managed to get in on a billion-dollar takeover of Rockefeller properties. How did he pull that off? Ackman clearly knows a lot about building wealth and doing things right. So, when he shares money advice, you can bet he's on point. He recently mentioned, "Our view on inflation, or kind of the consensus view, is that inflation's going to stay high, which could show up very quickly, even in the coming weeks." But wait, it's not all bad news. No matter how tough the economy gets, the wealthiest 1% always find a way to stay on top, and even add a few new members to the seven-figure club. So, maybe they know something the rest of us don't. As we'll explore in today's video, inflation in 2024 might actually turn out to be an advantage for your finances. If you follow our guide, it could be an opportunity to secure your path to becoming a millionaire. In the world of finance, William Albert Ackman is a name that needs no introduction. He's a billionaire American hedge fund manager and the founder of Pershing Square Capital Management, a hedge fund that has made him one of the boldest and most outspoken investors over the last 2 decades. Although not all of his moves have been winners, Ackman has still managed to deliver a 635% return for his investors since 2004. Known for his proactive approach, he isn't one to set off alarms without reason. So, when he recently sat down for a rare, full-length interview and made some strong statements about inflation, people paid attention. But before we get into Ackman's practical strategies to profit from inflation, it's worth understanding why he believes we're in for a sustained period of rising prices, and why he doesn't see it going away anytime soon. His portfolio approach focuses on investing in strong businesses that he believes can thrive in nearly any economic, political, or macro environment. But he also hedges against risks, especially those tied to rising energy prices and long-term interest rates. Ackman has pointed out that with inflation around 3 to 4% and likely to stay high, locking into a 30-year fixed-rate bond at 4.7% doesn't seem like a great deal. Ackman believes this high inflation is partly due to the extremely low interest rates we saw in recent years, where borrowing was cheap. Since the financial crisis, the Federal Reserve aimed to avoid deflation and set a target of 2% inflation. But after the pandemic and the resulting flood of fiscal stimulus, combined with the rush of people going back to their normal lives, inflation skyrocketed. Now, with massive deficit spending, ongoing infrastructure projects, and the Fed's own sizable balance sheet, Ackman argues the U.S. government's finances aren't as well managed as they should be. If America were a business, he points out, having so much debt that needs refinancing within a year would be a risky strategy. The rising prices we're seeing today are at levels that haven't been experienced since the early 1980s. For years, people worried more about deflation than inflation, which might seem appealing at first, but can be bad for the economy in the long run. In 2012, the Federal Reserve set a target to keep inflation steady at 2% per year, but achieving this has been harder than anticipated. Inflation is mainly about the balance between supply and demand. When demand is high and supply is low, prices rise. We saw this happen in 2020 and 2021 when the government provided financial support through direct payments and low interest rates. People suddenly had more money to spend, but at the same time there was a shortage of parts needed to manufacture new cars, which pushed up prices for used cars as well. Ackman has a sharp sense for market shifts, and right now, he believes the high prices we're facing aren't just temporary. Rather than ignoring the bigger picture, he's paying close attention to indicators that suggest change is coming. First, global political and economic conditions are undergoing major shifts. Also, the cost of overseas manufacturing, once a cheap option, is climbing. Workers are demanding higher paychecks to keep up with the rising cost of living. And gas prices have shot up, forcing some people to rethink owning a car altogether because of the daily expense. The Federal Reserve's main job is to keep the economy stable and ensure our money holds its value for everyday needs. To help control inflation, they've raised interest rates, making borrowing more expensive in hopes of slowing down spending and stabilizing prices. And while these moves have had some success in easing inflation's intensity this year, Ackman thinks it's not enough to make it disappear entirely. If Bill Ackman's right and prices keep climbing, brace yourself, because interest rates might just rise even higher than they are now. Imagine that, a scenario where already high rates go up again. It's a worry for investors who have financial goals and hopes for profits, since such a shift could send shockwaves through the stock market with massive effects. But don't lose hope. Ackman believes we'll adapt to this situation, just like we did with other economic ups and downs in recent years. Think about Ackman's perspective. He's got a good point. Businesses that are resilient to inflation can actually thrive as long as their costs don't spike as quickly as their profits. Historically, a business's value is often determined by the cash it can generate over its life, discounted by a reasonable interest rate. That's why Ackman feels confident holding these kinds of businesses, even in times of high inflation. To follow in his footsteps, we need to study his approach. Surprisingly, Ackman's investment philosophy has a lot in common with Warren Buffett's. Both were inspired by Benjamin Graham's book, The Intelligent Investor, which shaped how they view the market. Ackman is a classic value investor, always looking for solid, hard-to-beat companies that he believes the market undervalues. Instead of quick trades, he prefers a long-term approach, seeing his firm Pershing Square more as an investment holding company than a typical hedge fund. Ackman's strategy has clearly paid off, helping him consistently make substantial profits no matter how challenging the economic environment. His portfolio isn't stuffed with 100 companies either. In fact, he's invested in only 7 firms covering various sectors, from Chipotle and Restaurant Brands International, which owns Burger King and Tim Hortons, to Canadian Pacific Railway and Transportation, Howard Hughes in real estate, and even Alphabet, Google's parent, in tech. 2 key features stand out in Ackman's portfolio that make these companies well-suited to thrive during inflation, and maybe even benefit from it. First, he focuses on companies with an asset-light model. For example, rather than owning expensive properties, Restaurant Brands International, RBI, uses a franchise model. Franchisees own the physical restaurants, while RBI collects fees based on sales without having to spend much on property or equipment. This setup makes RBI more resilient to inflation, as it can earn more as prices rise without additional costs. It's a powerful way to profit in inflationary times. The second feature is pricing power, which allows a company to raise prices without losing customers. Take Canadian Pacific Kansas City, for instance. As a railway company, it's often a cheaper option for moving goods over long distances than trucking, giving it leverage to adjust its prices if necessary. Chipotle, another Ackman favorite, has a strong customer base that remains loyal even as menu prices rise, similar to the way Coca-Cola has such a dedicated following that people stick with it even when it costs more than other brands. Ackman and Buffett share this love for companies with solid pricing power and loyal customers, which helps shield their value during inflation. It's why Buffett is so keen on Apple. Its ecosystem keeps users loyal, even as competitors offer similar, often cheaper alternatives. And, much like Buffett, Ackman's strategy focuses on companies that essentially act as royalty earners in their sectors, gaining from industry growth and weathering inflation well. But it's essential to note that not every industry is a safe bet in high inflation. Durable goods and retail are often the first to suffer, as people tend to cut back on non-essentials when prices climb. So, if you're considering investing in these areas, be sure to weigh the risks and research each company carefully. One of the safest ways to hold value in inflationary times is through a diversified portfolio that balances bonds, commodities, and inflation-protected assets, helping reduce stock market losses. That said, even for experts like Ackman, there are no guarantees. Traditional inflation hedges don't always work, and unusual economic conditions can sometimes make unexpected assets perform surprisingly well. So, stay informed, keep your options open, and learn from the best.